Do you want the potential to make money 5 different ways when you're trading? Of course you do, right? So what we're going to cover today is for you. And we're going to talk about vertical spreads. And in general, they are one of the most versatile tools that we have in our tool belt as traders. Credit spreads in particular, what they do is they'll open up a world of opportunity because they can be done with either put options or call options. And this gives us a ton of flexibility, and we can trade in different market conditions. If you don't mind just hitting the subscribe button down there and that little notification bell so you can always be aware when we post new videos. And we actually use credit spreads on individual stocks as well as ETFs. And it doesn't matter if it's a volatile market or a slow market. So one of the things that we love about credit spreads is they offer a better probability of success than just buying calls or puts. When you do this correctly, credit spreads can actually provide a consistent return over time. And I think that's why every trader that's trading options should take a look at them. Now, a call credit spread, that is a bearish option strategy. And we use that when we expect a neutral to moderate decline in the price of the underlying asset. So essentially, we're selling an out-of-the-money call option and buying an even further out-of-the-money call option. So the trade is actually open for a net credit, and that's the difference in premiums between the two different options. Now, the maximum profit is equal to that credit that we receive, okay? So it is limited, and that is achieved if the price of the underlying asset falls below the strike price of the short call. The max loss, well, that's equal to the difference between the strike prices of the two options less the credit received, and it occurs if the price of the underlying asset rallies above the strike price of the call. Now, although this strategy limits profits, as we mentioned, it also limits your loss, and that's a good choice for investors and traders who want to take a more conservative stance on a price decline. And really, when it comes to options trading, one question that often arises is whether trading weekly or monthly. Now, there's pros and cons to both of these, but the answer ultimately depends on your goals and your preferences. So weekly options are going to offer a shorter time frame, right? So they're going to be more responsive to changes in the underlying stock price. However, they can also be more volatile. They can be less forgiving than monthlies. So if you're just starting out, we do recommend using monthlies with about 20 to 40 days left to expiration. So this is going to give you a little more time to get comfortable with the strategy before you move into the more volatile weeklies. But ultimately, look, it's up to you to decide which approach is going to be best for you. There's no right answer. There's no wrong answer. But we have always recommended that if you're a new trader, you take a more conservative approach when you're first starting out. So how do we build these trades up? Well, the credit spread is simple, right? But it's effective. And again, we can use it in almost any condition. So the key to success is to choose the right options and to manage it. So to construct a credit spread, the first step, well, weekly or monthlies, what are you going to use? So the next step is to select the strike price for the options. So we recommend selling the call option that has a 65% chance of closing out of the money and buying a call option that is further out of the money. So we look to collect between 30 to 40% of the distance between the two strike prices. And we're going to talk about that in a minute. But with proper management, this trade can actually make a consistent profit. How much can we make? Well, it depends on the premium that we have received for selling the call credit spread. So if the premium was 50 cents, the most that we can make is $50 per spread. So as long as that underlying price stays below the strike price of the option that we're selling, we're going to make money. Now, as soon as we place a trade, we know exactly how much we can lose if we are wrong. The most that we can lose on this trade is the difference between the strike price minus the credit we have received. So let's pretend you sell a credit spread $2 wide at 50 cents. So our risk is $2 minus 50 cents, $1.50, or $150 per contract. The most that we can lose on this trade is $150, but the most that we can make is $50. That sounds stupid, right? To risk more to make less? Because we've always been taught, right? Reward to risk 3 to 1. The thing is, these trades have a higher probability of success, and there are 5 different ways that we can make money. Also, we don't let that reward to risk get skewed out, right? So for example, risking 2 to make 1, or risking $3 to make $1, that's acceptable to us using this strategy. But, risking 5 to make 1, that's a little bit unacceptable for us. So I talked about having 5 ways to make money, right? This is why we like to use this. We earn a profit from the call credit spread if the stock goes up, if it goes down, or it goes sideways, as long as that value does not surpass the strike price of the option that we sold, right? This is why we want to have a bearish outlook on the underlying asset. Each day that passes and the options get cheaper, we're making money, right? This is called time decay. When volatility decreases, the options get cheaper, and then we look to close the position by buying the spread back at a cheaper price than we sold it at the opening for. Now, trade management is crucial for this, all right? The only way to maximize profits, obviously, is to hold the trade until expiration, but that's not always practical, right? So the next best thing is to close a trade early. Sounds odd, I know, but we do that when it's 50 to 75% of the maximum profit has been achieved. So for example, let's say you collected 70 cents to open a trade, right, at $70. You would look to close a trade by buying it back at 17 cents to 35 cents. So that's going to allow you to keep 50 to 75% of the original 70-cent profit. Now remember, there's 100 shares in an options contract, so 70 cents is not 70 cents, it's $70. So when we manage our trades this way, and we're not looking for the home runs, we actually increase our chances of booking profitable trades, right? It makes for a great equity curve. So let's look at an example. This is a bit older, but we're going to use SPY. So we determined that we want to place a neutral to bearish position using a call credit spread. So we decide we're going to go with the October 16th monthlies. They have 15 days left to expiration. So we go to the 342 out of the money call option. Has a 65% chance of closing out of the money. We sell that option as part of our spread. But we also buy the 344 call at the same time. Now we are in a risk-defined trade. So there's a $2 difference between the strike prices. And that means we want to collect between 60 cents and 80 cents. Remember, it's $60 and $80. Because that's going to allow us to collect between 30 to 40% of the $2 difference between the strikes. Selling this spread to open for 70 cents is going to allow us to collect the $70 per spread. That's the most that we're going to make on this trade, okay? $70. Our maximum risk is $1.30 or $130 per spread. And we calculate that by taking the $2 difference between the strike price of the options, subtracting the 70 cents that we collected to open the trade. So our break-even point on this trade is $342.70. We calculate that by taking the 342 call strike of the option that we're selling. We add it onto the 70 cents that we collected to open the trade. So if SPY moves higher, lower, sideways, we're going to make money as long as it stays below 342.70. Now we also make money from time decay adding up and from volatility decreasing. Now we could hold to expiration, hoping to keep that full $70 profit, but we don't like the risk of holding to expiration. We prefer to close the trade out early when we can keep between 50 to 75% of what we collected to open the trade. So in this case, we want to buy the spread back for between 17 cents and 35 cents. That's $17 and $35. Now the maximum gain would be awesome, but there's something to be said for ensuring that you bank a big percentage of the potential gain that you could have made. Now, these have good profit potential, okay? The odds are high you're going to make some money, but it's still just an individual trade that could win or lose. So using large amounts of capital on one big trade is the wrong way to approach your trading. We've always recommended keeping the risk on each trade at between 2 to 5% of your account. So if you do have a losing trade, it's a conservative approach, not going to wipe you out. If you get your sample set of trades big enough, you're going to make money over time. Here's some quick facts for you. Call credit spreads bearish to neutral. And that involves selling an out-of-the-money call option and buying an out-of-the-money call option with the same expiration dates. So the goal of this trade, we want to collect the premium, and we hope that the stock price stays below the break-even point. That's why we're going to make sure it's bearish. The maximum profit is the premium collected when entering the trade. The max risk, the difference between the two strike prices of the two options minus the premium collected. It is so important that you use proper position sizing and risk management when you're trading a call credit spread. And this trade benefits from time decay and decreasing volatility. It's often closed out early because we want to keep a portion of the premium collected. Let's wrap this up. You have to be prepared for anything the market's going to do when you're trading, right? The call credit spread, I think it's a great way to place a more bearish trade while still having potential for profit and minimizing your risks. So you're going to have good probability of success with this kind of trade. And the position will be far more forgiving. But to make money, you don't need to be perfect in your market direction when trading this strategy. And it's a much less stressful method than other methods. And that's why it is a go-to strategy for most successful options traders. So we have a free guide for you. And if you're ready to trade two of the world's most high-performing markets. So it's a one-day options trading strategy. And what it's going to do is give you the opportunity to enter and exit the market the very next day, right? One day. You're going to have immediate access to this valuable information, right? So you can start trading right away, and it's totally free. So the markets that we chose, and they're known for their high potential profits, and it's a pretty unique strategy. You can download this guide. The link is above or below. Just grab it, see what you think. Any questions or comments, you can pop them below. Hey, make sure you hit like and subscribe. It'd be really awesome. We'll talk to you soon. Thanks.